Welcome to another REG walkthrough video. I'm Logan, and in today's video, we're going to be going over C Corp estimated tax payments, and we'll also be going over how the foreign tax credit works for C corporations. And we're going to be doing that the SuperFast CPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, and if you want to learn more, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam, and again, it's 1 hour, it's free, and it will save you so much time in struggling with your process. Make sure you go check it out. The link will be in the description. Also, if you like the idea of going through questions as your main learning material, be sure to check out our Superfast CPA app, where we not only have audio notes and review notes, but we also have 5-question mini quizzes that you can easily access on your phone throughout the day to continually be practicing. With all that said, let's dive straight into the few questions that we have for this video. All right, here is question 1. XYZ Corporation, a C corporation, operating on a calendar year, reported a tax liability of $200,000 for the previous year in year 1. For the current year, year 2, XYZ Corporation estimates its tax liability to be $250,000. XYZ Corporation is determining its required quarterly estimated tax payments to avoid any underpayment penalties. Assume no significant changes in tax laws between year 1 and year 2. What is the minimum amount XYZ Corporation must pay in each quarterly estimated tax payment for year 2 to avoid underpayment penalties? So if you know anything about estimated tax payments for individuals, you might think about that in this situation. This is a little bit different for C corporations though, so let's go ahead and dive into the answer to learn how this works. Okay, so the minimum that they would have to pay each quarter is $50,000. Let's learn about that. According to the federal tax laws governing corporations, XYZ Corporation must make quarterly estimated tax payments to avoid underpayment penalties. To do this, XYZ Corporation must pay the lesser of 100% of the tax shown on the previous year's return, or 100% of the estimated tax for the current year, divided into 4 equal installments. Since XYZ Corporation's tax liability for year 1 was $200,000 and the estimated liability for year 2 is $250,000, XYZ must pay at least $50,000 each quarter, which is 100% of the previous year's tax liability of $200,000 divided by 4 quarters, to avoid underpayment penalties. And one more thing here, if the corporation's income is uneven, such as they have a lot of income in one time of the year and very little income in another time of the year, it may benefit from using the annualized income installment method, which allows the corporation to annualize its taxable income for each period and make payments that correspond to the income of each period. However, this probably isn't something you'll need to know too much about for the CPA exam, but I did want to throw it out there that that is a possibility for C corporations who have a lot of income in one time of the year and then not so much in another time. They can annualize it so that they pay a lot during that time of the year and maybe less at another time of the year. However, in most situations, we're going to be focusing on this, taking the lesser of either 100% of the previous year's tax liability or 100% of the current year's tax liability. And all of this is to avoid underpayments. So we learned about that. Let's go ahead and go to the next question. Okay, here is question 2. QRS Corporation is a C corporation with taxable income exceeding $1 million for the past 3 years. In year 1, QRS Corporation's tax liability was $1,400,000. For year 2, QRS Corporation estimates its tax liability will be $1,600,000. What amount of quarterly estimated tax payments must QRS Corporation make in year 2 to avoid underpayment penalties? Okay, so we did just learn about this, the lesser of 100% of the tax liability for the previous year or 100% of the current year tax liability. However, there is a rule that we're going to look at in this. So if you want, take a second, pause the video, see if you can get the right answer. But if not, let's go ahead and go straight into the answer to learn about the one exception to this rule. And here is the exception. So the answer would be $400,000. You're like, what? That doesn't make sense. We just learned that it's either the lesser of the two. But let's learn a little bit more about it. A large corporation, for the purposes of U.S. federal income tax payments, is generally defined as a corporation with taxable income of $1 million or more in any of the 3 preceding tax years. So if you have $1 million of income in any of your preceding tax years, then you are considered a large corporation. And that's who this rule applies to, is large corporations. For a large corporation, the estimated tax payments must be based on the estimated tax for the current year. Since QRS Corporation estimates a tax liability of $1,600,000 for year 2, it must make quarterly estimated tax payments of $400,000 each. And that would be the $1,600,000 divided by 4. and all the rest are incorrect because, this one is basing it off of the previous year's tax liability, which, again, because they're a large corporation, you can't. C is incorrect because that's kind of applying that niche rule that we talked about in the first question where they can annualize their income, which, again, not really something you'll apply hardly at all in the CPA exam. So that's also not true. And then they can't pick between the two because, again, a large corporation has to do 100% of the tax liability in the current year. So this is one of those situations where instead of the lesser of, it has to be in the current year if you're considered a large corporation. Okay, with those two questions, we've learned basically what you need to know for estimated tax payments for C corporations. We're going to do one more question in this video going over the foreign tax credit. We've gone over this in a previous video, if you remember, but we're going to talk about it specifically in the context of C corporations where it is a little bit different. So we're going to do that question. Let's go ahead and go to it. Okay, here is question 3. Global Tech Inc., a U.S. corporation, earned $800,000 of taxable income from its U.S. operations and $200,000 of taxable income from its operations in country X during year 1. Global Tech paid $50,000 on income taxes to country X. The U.S. tax rate for corporate income is 21%, which, by the way, that is the real number. In a lot of these videos, we don't use the actual rates or the actual numbers because they change so much, but this 21% has been around for a while. It could change in the future, but this is the current number in 2024. To mitigate the double taxation, Global Tech must decide whether to take a deduction or a credit for the foreign income taxes paid. Calculate the possible credit and deduction. Based on that calculation, take the better of the two options. What would the U.S. tax liability be after taking the credit or deduction? So with C corporations, there is the foreign tax credit, but they also can take it as a deduction instead of a credit. So you have to figure out what the deduction would be and what the credit would be, and you would most likely choose which would give you the lowest tax liability. So let's go ahead and look at the answer to understand how you do this calculation. Okay, and the answer is $168,000. So this is the lowest tax liability available when we're trying to calculate this. So let's do the calculations. First, you have to calculate the tax liability if they took the deduction. So the deduction is you just take the foreign tax and you deduct it from your taxable income. And then after you've deducted it, you calculate your taxable income. So you take away the $50,000 of foreign taxes paid, and then you calculate the tax, and that gives you a tax liability of $199,500. And then for the credit, if you remember right, again, we learned how to do this for an individual. It's pretty much the same. First, you calculate the total taxable income, including the foreign income. So take all the income, calculate the tax. So it would be $210,000. Then you have to take the amount of foreign income as a percentage of the total income, which was $200,000 of the $1 million. So that gives you 20%. And you multiply that by the total tax liability. And that gives you the limit to how much foreign income tax you can take as a credit. So this is the limit. And since the actual foreign tax paid of $50,000 is more than that limit, they can only take up to that limit. So this is the credit. And the way that credits work is they reduce your tax liability, not your tax income. So you take this credit away from the tax liability that was already calculated up here, and that gives you a reduced tax liability of $168,000. Now, obviously, this is significantly better than this. And in a lot of cases, it probably will be, but there is that option for C corporations where they can take the deduction or they can take the credit. Maybe for simplicity, they would take the deduction or other things. But for C corporations, when it comes to the foreign income tax credit, you can take either the credit or you can take a deduction for the foreign income taxes paid. And that's all we're going to go over in this video. Let's do one final part of the SuperFast CPA strategy, which is something called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, and after you've done your questions for the day, you take a second and you think about the things that you learned from those questions. You think about the topics and the concepts that kept coming up throughout the questions that seemed like the most important things because you saw them multiple times throughout the questions. They were obviously something you needed to know according to your review course. So let's go ahead and look at the pillar topics for this video. All right, here are the pillar topics for the video. So first of all, for C corporations to avoid underpayment penalties, they must make estimated tax payments based on the lesser of either the 100% of the previous year's tax liability or 100% of the current year tax liability. However, if the C corporation is considered a large corporation, then they have to pay 100% of the current year tax liability. They don't get a choice between the previous year or the current year. And also, C corporations can choose to take foreign income taxes paid and use them as either a deduction or use them in the foreign income tax credit. And you would just need to calculate which of the two would lower your tax liability more. And that's it for this video. I just wanted to go over those two simple topics. To finish up, I just want to remind everyone of the free 1-hour webinar training that we have at SuperfastCPA.com. Make sure you go check that out. Also, if you liked going through questions as your main learning material, be sure to check out our Superfast CPA app, where we have 5-question mini quizzes that you can use all throughout your day to continue improving and practicing. If you liked this video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.